Welcome to the Big Fat Real Estate Checks podcast with Marco Kozlowski, where we help investors like you get the knowledge and skills you need to replace your JOB with passive cash flow for life.
Hey, Marco here. I really wanted to share with you our earlier podcasts that we created. Now, our mics were not the best, but the content was really strong, and I know you will learn a lot. We had an absolute blast recording this, and I know you're absolutely going to love it as much as we loved recording it. This extremely content-rich information will not only give you the edge in your real estate investing business, but in everyday life. Enjoy. All right, boys and girls, we're back for due diligence now on the commercial side, specifically multifamily commercial. So multifamilies that are, I'm going to say under 100 units, because over 100 units, you're going to have a different series of checkpoints and probably your own management team in order to make that into the best possible property that it can be. So we're going to just say under 100 units-ish. We're going to have these series of due diligence items in order for us to do our checks and balances to see if this is something that we either want to buy, wholesale, or run away from. Where do we start?
Well, I think some of the similars, if you watch the other podcasts on residential, there's some similarities with commercial DD. And with the commercial, so this is, again, 4 and up until 100 units. The first thing is we verify the income.
Yep, that's right.
And there's certain tools that we verify. And these are typically when you're dealing with larger units, you're not dealing with mom and pop. So you still may be, but you're dealing with more separate entities that hold these particular assets. So you would ask for, what do people have to prove their income? And one thing we ask for is profit and loss statements. So we ask for profit and loss statements. And in addition to that, we ask for general ledgers. And what general ledgers are is if you know what a profit and loss is, so it has a column of all the income, so all the income for that property, and then it has all the expenses. But the expenses are broken down into categories, all right? Mm-hmm. So they may have repairs and maintenance, $30,000. Now, what a general ledger does, and that's why we ask for it, it breaks down what that $30,000 is. So we can look at each item, and if there's something that pops out that looks suspicious or out of the ordinary. What we do, we typically ask for 3 years. And we ask for 3 years because we want to see consistency. Mm-hmm. So we don't want to see a spike in properties because, it does happen. Like in Texas, they have that scenario where if there's a hurricane, there's a spike in occupancy. In Panama City, Florida, I'm going through right now. I have some properties and now there's scarcity. It's supply and demand. Most of the properties, they got hit last year with Hurricane Matthews in October, which was devastating. It was 3 miles less than a Category 5 that made landfall, and it devastated the whole Panama City and the Panhandle in Florida. And what happened, it took a lot of inventory out, and what happens is income obviously went up because people are looking for places to live. So that's why we ask for 3 years. So we have a comparative over 3 years in terms of the fluctuation. And it's always going to be up and down, but if you see a big spike, then that's a problem.
Or if it's in the energy sector as well, where you have, they struck oil and the whole area is based on the oil industry or oil and gas or energy. And then if the price per barrel drops, then no one wants to live there anymore because they don't drill there or they don't mine there or whatever
If it's industry dependent, basically, that's something you want to validate.
Yeah,
that's right.
Yeah. So then we'll have different checks and balances for that. But make sure you know where the tenant base is coming from. It's very, very important.
So your profit and loss is your basically your starting point. You're going to take the P&L that they supply you with, and then you're going to validate that what they're saying there is correct. And again, we're going to start with revenue. The revenue is fairly similar to revenue in a residential, where you're going to ask for all the leases, copies of the leases. You're going to or check a rent roll. You can have a rent roll given to you, and then you're going to validate that they're actually collecting the income. And to do that, it's the same thing. You're either going to check bank statements. Again, like Frank said, they may be more sophisticated than the larger multifamily, so they might have a separate bank statement for that property itself. It'll be a lot less invasive than when you're asking someone's personal bank account, because that's where they deposit their checks. There's also the tax returns where you can validate what kind of income they're declaring. What else can we do for income? It's the deposit receipts if they don't want to give you bank statements.
Yeah, and we like to compare all those. So the reason we're asking for this, we're not paper collectors. It's just with the P&L, we look at the P&L. So we look at
numbers.
we look at that revenue, and typically, actually, we've been asking for not annual P&Ls, monthly. And I'll tell you why. Because when you get a monthly P&L, you'll see what they generated for that particular month, and then we like to compare it to. Let's compare it now to the rent roll. So does the rent roll match up with the P&L? And then we like to compare it to the bank statement. Does the bank statement compare to the rent roll and the P&L? And then we ask for the tax returns, which is on an annual basis, of course.
Correct.
And then if they don't, there's going to be some variance, but if there's a big discrepancy, you're going to question the seller and say, hey, your rent roll for this particular month on this year does not compute with the deposits made for that particular month.
What happened?
And what happened there? And there could be a logical explanation. Maybe some people do take the income, and before they deposit it, they spend on some of the expenditures, which is not really the proper way to do it. But they take the rent in, they go, okay, we got to pay for a new air conditioner, and they'll spend it, and then they make the deposit, and that may be the discrepancy, and that may be justifiable.
Yeah.
So we ask for those 4 things and compare them month to month. Yes.
So hang on a second. So first we're going to look at P&Ls, right, which are profit and losses. And we're going to go through that and see if that makes sense. Now, if I've never seen a profit and loss statement before and I look at it, it could look like complete,
Scary.
Chinese and scary. Exactly. Quite daunting. We're also going to look at rent rolls. Now, for those of you that don't know what a rent roll is, it's a list of Mary lives in 1A and she pays $900 a month, and she's been there since October of 2017, and her lease expired in 2018. She renewed, and now for the next 5 years, and this is when her lease expires. And it basically gives a whole list of who's in the property, who's paying, who's not paying, and it gives you a snapshot of who is in the building and when their leases are up and when they're not up. So it gives you a really good snapshot as to what the income is from a month-to-month basis. And then you can compare that to the monthly P&L as to what the income should be, because if you take a look and just add all those columns up for the month, let's say of September, if September says $34,000, but they only deposit 10,
that's a problem.
What happened, right? What's going on there? Then we also want to look at the yearly tax return to see what they actually claimed, to see if that's similar to what's on the books.
Yeah, and that's delicate, right? Because it could be that they're not declaring all the income, because there's some people that actually take in cash and only declare what they get in checks because they want to reduce their fiscal bill, which isn't something that's strange. It's actually quite normal for some people. So
we don't recommend it necessarily.
Yeah, that's right. No, I mean you got to play by the rules, but it's some people do that, and it doesn't mean because their tax return doesn't. This is why we do everything else, because if everything else matches but the tax return doesn't match, they'll tell you that they don't declare all their income. That's something that people for some reason are not afraid of telling you, but you still have to ask for it and make sure it checks. Obviously, if they're completely honest and they actually declare all the income that they collect, that should match with all the other facets of verification that you've done, and then that's going to close your revenue verification portion, and then you can move on to the expenses.
Now, if they're all different, we're going to use the lowest possible number.
All the time.
Yeah. So if one doesn't match the other, that doesn't match the other, we want to be as conservative as possible because it can only get better. We don't want to buy expecting, to make more money. We want to, expecting to make more money, but we actually make less. I'd rather expect to make less, but we actually make more. So.
And notice that we never want to buy the property. We always find reasons not to buy it. So, and that's sort of something that you should be doing yourself, because a lot of people just are married to the property and, don't worry, it's going to be this, it's going to be that, it's going to work out. Well, no, and it often doesn't. So if you always put yourself in the worst position possible, that's how you mitigate risk, is being super conservative within reason. And then there's only, like you said, Marco, there's only one way, and that's up, and that's what we want.
Yeah, we want to be worst case scenario people, and if we can make money in the worst case scenario, then we're going to be fine.
That's right.
Expenses.
The expenses are, again, they're similar to the residential in the sense that it's there's just a larger tax bill that you can go get from the county. You can get on Zillow. You can get the tax the tax bill pretty much anywhere. You can also ask the seller. I like to do this personally, is ask the seller for all the information and just corroborate it, because two things happen. One, you can see if they actually match, which is good. And if they do, then you know that your seller is probably honest. If they give you things that are not correct, like if they give you a tax bill and it's only for, because they pay the taxes 4 times a year and they only give you one of them, and then you only have 25% of the taxes for the year, and then you go check in the county and then it says that it's 4 times more, and then you have to question, he says, oh yeah, I got to pay these 4 times a year. Well, then you have an idea of what type of individual you're dealing with as well. But at the same time, you're covering your ass, which is what's important here, is making sure you've covered all your bases. So taxes, insurance, you can ask for the quote again, but whatever they get as an insurance quote is something that you have to really look into, because their deductibles may vary, their level of coverage may vary, their liability insurance, if they have any, may vary. You want to actually get your insurance broker, your insurance company to quote you based on what your needs are, and then use that as the number, because that's going to be an actual on your expense list. It's not going to be a maybe. If your insurance company quotes you $12,000 for the year, then that's the number you're using, even though their insurance is $8,000. So taxes, insurance, maintenance. Maintenance is where Frank spoke about the GL. That maintenance is interesting, because what the number you're going to see on the GL, on the profit and loss, is a total amount for the year, which consists of probably, tens and maybe even hundreds of different maintenance issues, whether they're maintenance items, whether they're labor. So the only way to actually validate some of these items is through sampling. So when you get a GL, let's say the maintenance number was $50,000 for the year, and you ask for the GL, you're going to see that the $50,000 consists of a number of items. So let's say there's 100 items in there. You can randomly select, let's say, 15 of these items, and you can select number 1, number 15, number 30. You can do whatever you want. You can make your cat pick, your child pick, whatever you want. Close your eyes and point. It's up to you. And it's actually better to do it this way. So you randomly pick. Don't even look at the amounts, whether they're $1 or they're $1,000 or $50,000. It doesn't matter, because I have a background in auditing, and I've seen more mistakes in the 1 cent and $1 amounts, where that was a huge mistake, because they know that everybody wants to look at the big numbers. So where do they screw you is on the little numbers. So just pick randomly 10, 15 items and ask for the bill. Ask for the actual invoice that supports that amount. And if they give you all these 15 items and they match, then you know that probably everything else matches as well. If 7 of those are wrong, then you know that that's a red flag. Ask for another 15 and see how many more mistakes there are. And you know what? If you got to check them all, then you check them all, because you want to make sure that you're not inheriting someone else's problem here. Yeah. So the maintenance ones is a bit of a crapshoot, but this is how you mitigate the risk.
Actually, another tail sign that they're maybe BSing is round numbers.
Yeah.
I don't see too many things that are round numbers. So when there's round numbers, it's their estimate, or they're just throwing something out there that's not actual factual.
$40,000 in maintenance cost.
Yeah.
It can't be $40,000 even. It's impossible.
It's fluky if it is,
Yeah.
but likelihood it's not. So when you see round numbers, or you see certain amounts that
you want to see cents.
Yeah, you definitely want to see cents. Yeah. But and you know what, even on utility bills, if you see the electric, and I've seen this before, they had electric at $350 each month. Like
flat.
Really, like throughout the summer, winter, when you put your heat, when you put air conditioning, there's no way in hell.
Mm-hmm.
So anyways, those are just little, I know you mentioned
forensic. No, but now that you're speaking of utilities,
yeah.
That's another point. Like utilities too, you can ask for a couple of, typically they'll have 12 different bills for the year, 1 per month. So you can just ask for, 3 random ones. You can go like February, April, and, November. Ideally, maybe you can just take 4 and pick 1 per season, just to have an idea.
Actually, most of the utility bills, I think right now they have your history on there, so they'll compare your last 11 months, or they'll compare you to last year on that time or whatever. So
in any case, it's a simple verification. Same thing with if they have telephone, internet. If it's a big complex, they likely have some internet in there. And then,
well, let's make sure that on the P&L, the same as residential, there's certain things that need to be in there, which are your taxes you mentioned, which are the insurance, and make sure there is management, that someone's operating the ship, and maintenance, that there is reasonable maintenance in there.
It should be around 10% of whatever the gross is.
Exactly.
And if it's a lot less, then they're probably underreporting, and if it's a lot more, then there's a lot of deferred maintenance, so you might want to take a look at that as well.
Which you'll see in the inspection later,
Yeah.
but it's going to be it's like a telltale sign of what to expect.
So the TIMS has to be there whether it's
Yeah.
residential or commercial. So that's your taxes, your insurance, your maintenance, your management.
Now, management may not be there if they manage. I mean, there are some people, even if they own a 50 unit, that take care of their own properties. There's just some people that love to manage their own stuff. But if there isn't a management, you have to assume that there's going to be an additional 10% of gross income that's going to be taken as management.
That's right.
So you put that in there. I mean, you're going to look at the P&L. There's things that they might have auto expense, which, you know, you're not going to have the car expenses because they like to, if it's an entity, they like to write off their cars in there. They like to write off a bunch of their things. You'll see that there's certain things that are not really relevant in the way you're going to operate. But as long as your TIMs are there, that's super important.
There'll be some add backs as well, like depreciation and amortization, which are actual paper expenses.
You can't verify those.
Yeah, so just if they have those in the P&L, you have to add them back into the NOI or the net operating income because it's not a real expense. It's a paper expense.
And you're going to undervalue the property, and then you may be losing out on a good deal
on a really
because
good
you're not
deal.
doing your math right.
Exactly. So just make sure you take a look at that. And I know at first it might sound like, wow, this is really complicated. Excuse me. But once you actually start doing it and looking at it, it becomes quite simple. At the end of this, I think we'll ask you to go take a look at a P&L. Just go on LoopNet and just find a property that's for sale. Take a look at a P&L or
An OM that's inside, yeah.
or an OM, and you'll be able to see these expenses and you'll see for yourself if these things make sense or not.
And typically the M&M's missing, like in residential.
Yeah.
The M&M's, the candy's always missing. It's always taking the candy away.
Always taking the candy.
So yeah, definitely took a look at that. So and again, we do this. We trust the seller or the agent what they're telling us.
Verify.
But now we're at the verification. Trust but verify. That's our model. Is trust. We trust you, but we're going to verify what you're telling us, and that's being responsible to not only yourself but also to your investors and your lenders that are giving you this money to make that acquisition, right? So even though you're not playing with your own money, you still got to respect that someone's giving you money and trusting you for that, and that's the most important thing. Otherwise, if you don't and you do shitty business, you're not going to be in business for very long. So once you got your income and expenses verified, your next thing is?
Well, in a bigger property, I like to get the management out there pretty quickly as well. So, again, we go 3 management companies. They get you need to have 3 management companies that are willing and able to manage. You send them out there, you have them look at the premises, and you have them report to you as to whether or not they are willing to manage, they're able to manage, and what they feel is necessary in terms of maintenance to be able to, rent out any vacant units that are there or not. Once you have that management settled, then you can also have your inspector go out there and provide you with a report. And in a commercial property, the inspection is similar to the residential one. The only thing is your lender may require a phase 1 environmental study. And so that's something that sometimes your inspector can actually provide as well. So if you have that up front, you can tell your inspector to have that done, just like we had recently done on the property we're looking at. Sometimes the inspector that you're going to hire does not do environmental. You're going to have to look for someone else and have them sent there to do an environmental.
What's a phase 1? Do you know what a phase 1, for those of you guys who don't know, it's basically a desk assessment. They don't necessarily go out to the premises to do a phase 1 environmental. They'll look at, they tap into like 15 different government websites to get information that they have access to see if there was any contamination or if a train tipped over or if there was a
gas station on
a gas station that, one of their tanks leaks. So do that. And if there's a reason for concern during the phase 1, which is the desk inspection, then they'll do a phase 2 where they actually go out to the premises and do soil sampling and shit like that and other things. Typically, we're not in that situation. I haven't had a phase 2 requirement.
No, ever.
But phase 1, yes, depending on the area, especially those energy dependent areas, they do. If you're very close to where they're drilling for oil, they may ask for that because it's contaminated land.
And that actually adds up to quite a bit. They can be quite expensive, those phase 1s and phase 2s. So
and if they
and
find
it's
something,
not always necessary, but if it's necessary, it's necessary.
Because if they find something, you have to clean it up before you can actually buy it, and the cleaning up part is a whole other cost benefit analysis. So
going back to the inspection, so that's one thing. You can hire a third party professional inspector, and there's other ways to get inspections even by government agencies that go out and willingly for free.
HUD will do that. Yeah.
HUD, for those of you that are familiar with the Voucher A program, which is they're helping people that have financial hardship. They help them out in a program where they subsidize all or part of their rent. And if you phone up HUD and say, I want my property to be, we're acquiring this
Section 8
property, we
approved.
want it to be Section 8 approved to help out folks. They'll come out and they'll take a look at the property. I don't know if they look at every unit, but they'll take a good sampling of it for sure. And that's important even if you get a third party inspector. You don't want them to inspect every room because it could be quite hefty. So if you're looking at a $100
Every
unit
unit, yeah.
building, you may want to inspect. Typically, it's about 20%. They do random checks at 20% of the units. So, but getting HUD in
You could
there,
do a 20, you could do 30, you could do 40, you could do 50.
Oh, typically
It
they-
just keeps adding up the more you do, and the more the
The inspector also is I mean, they're used to this, so if they're gonna start by sampling 20, but if they see problems everywhere, they'll increase their
Yes,
sampling.
exactly.
They'll call you and tell you, hey, listen, I found a lot of problems. Is it okay if I do another 10? Do you want me to go ahead
and
with
we
that?
get to choose those numbers. It's not up to the seller.
That's
So
right.
that's extremely important. It's not like we want to see the units that the seller told us to take a look at. It's exactly like sampling and with the receipts from before. We want to randomly pull a selection and take a look at those.
yeah. So whether you're using the third party inspector or HUD Section 8 to come out and they'll make a checklist. Say,
Or
okay,
both.
Or you can do both, yes.
Because I want the HUD inspector is not going to look at the roof and the mechanicals and the foundation. He's not going to crawl underneath, to find out if there's
No.
some foundation issues. But they'll definitely tell us, yes, it's HUD approved or not approved for collecting vouchers, which to get on the list to be able to get as many Section 8 people as possible.
And they typically ask for a little bit more than the typical, I guess, maintenance requirements for a unit. So if you get a HUD approval, then you're pretty much set.
Yeah, that's very good.
Yeah.
Okay, so we have our inspector, we're gonna get the report,
You
and
have
with the
your
report,
management.
what you could do is involve, if there is extensive repairs or significant pages to it, you may want to engage some general contractors. So you find 3 local general contractors, go to Google, just Google general contractors, and you can give them a copy of that report and say, hey, we're looking to acquire this, we're looking for someone to correct these issues, can you provide us with a written estimate? And at least you know that going in that you're gonna have to put that capital infusion into that property. So you're well equipped, there's no surprises. So that's what I would do is engage a general contractor
Yeah,
to get
For
involved.
sure. Yes, we actually get 3 quotes, and then I take the highest quote, bring it back to the seller, and say, hey, this is what it's going to cost, plus or minus 20%. So I'm actually going to ask for him to fix it, or her. Sorry. Either you fix it, or we'll put money in escrow plus 20%.
Yep.
Because once we open up the property and once we start working on it, there's always something else that's going to occur.
Be dug up.
It's never going to be. I don't know, a contractor where it's done on time for under price. Never happens. It's always more.
That's right.
So you always want to, account for those contingencies, and by asking for 20% more, or ask for a discount of that plus 20%. But I prefer to have it at escrow, and then if there's an overage, then they keep the extra. If it costs less, then the seller gets it back. I'm not looking at this as a profit center at all. I just want to buy the property for the price that we agreed on without it falling apart or being a danger or a potential lawsuit that could hurt us long term.
Yeah.
So that's very, very important as well.
And if you do get the seller, like you said, you're not making it as a profit center, but if you do get the seller and the seller agrees to make those necessary repairs, you would have to engage that inspector to go back out to make sure they're done
100%.
properly, because
100%.
I have had issues where the seller says, no, we took care of the whole list or whatever, this and that, and everything's good, here's the pictures or whatever, but they put lipstick on a pig basically, and it's not to code, and that's a whole different ball of wax. If you get the county and the city involved and they go in there and it's not the code, you're gonna get code violations, and you can't rent out the room, and then you're stuck to doing those repairs anyways.
And again, whatever that costs, it's an investment, because if you pay for that and you find out that it was lipstick on a pig, you just saved yourself a whole boatload of problems and financial problems.
It's a divorce waiting to happen.
Correct.
If you buy something like that, you wanna.
So I think we've covered most of this. So just again, we'll go back to management. It's super critical. If you can't find 3 management companies that are willing and able to manage this property, you right away you have to move to a separate exit strategy. You're not buying this. You're gonna either wholesale it to someone local who can actually handle it themselves, or you're going to just pass on the deal.
Or wholesale or
Yeah, actually, I just wanted to add something on with commercial, because we're dealing with, depending on the number of units, you may want to also ask in your due diligence on any vendor contracts they may have for either waste or landscaping or things like that, because some of these contracts, you can't breach them. They're set with that property for a certain time period, so you want to see if they have contracts with these vendors.
Yeah.
Do you honor them? Do you continue going through with them? Can you renegotiate them? So I would
Can you
definitely
get
ask
out
for that.
of them? Yep.
The same thing with the property manager, and the same thing with the tenants. So when you get the lease agreements, I know when you look at it, you can't throw out your tenants and just
No, you have to
increase. You
actually-
got to honor the
Yeah,
expiry
that's
of
a-
that lease.
leases. We also want the leases. I don't think we discussed that. We want every copy.
Oh
of
yeah,
every
we want
lease,
when you
100%.
you have to
Yeah.
have that,
Yeah.
and well, you're matching
And the
those to right role.
applications for the lease as well. If it's well run, they should have applications with copies of driver's licenses, so you can actually see that the lease that's there is with a real person with a driver's license that backs it. So those are good things.
And
to
if they
have.
do background checks, is because sometimes what people do, and people plan this. I'm not saying everyone's out to be a crook, but some sellers, when they know. So if I'm looking to sell my property and I am a crook, and I'm not. But if I were, and I was looking to sell my property, what I would do is to maximize my occupancy so it looks attractive. Is I would actually make up leases or get anyone in there without doing a proper background check, or they're not working or whatever, just get them in there. I would have even pay them. And there's been scenario, I think Marco, you had a scenario where the seller paid the tenant
To stay there.
to stay there to pay.
Yeah.
So it looks good on paper. And they'll even bullshit on their tax return.
Yep.
They'll inflate their income purposely. So these are people that strategize a year in advance to do something like that. And then once you go in there, you realize half of your tenants are not even qualified to be there. They can't even afford to be there.
They don't belong there. Yeah. Now those are horror stories, and they don't always happen. So
Yeah.
don't worry about that.
No,
But
but
No,
our
but asking for the
process-
application.
yes, and
the-
the more checks and balances that you have, the less likelihood that
Yes.
you're gonna.
Our processes are in here because of the shit that's happened
Exactly.
in the past. It doesn't mean it's gonna happen, but at least we're covering our rear ends, we're mitigating our risk. I think there's one thing that we didn't cover is if the property actually already has property management in place, you're gonna have to make sure that you wanna keep them. And you may wanna keep them, you may not wanna keep them, but that's something you're gonna have to do. So you always have to send out more management companies. I think we're gonna have another podcast on what type of questions to ask and how to validate whether you wanna keep them or not. But maybe just, you're gonna have to review the management agreement so to know whether or not you actually can terminate their services if you wanted to, and under what conditions you can do that, how much notice you have to give them, if there's a penalty for doing so, etc.
But that would be on the seller anyway. If they have a contract with the management company and they're selling, then
Usually there's an exit clause when they do sell
they
that
sell,
the
yeah.
management is free and clear. But you may want to keep them, but if
But you
they're
want to do that
underperforming,
before,
you don't. Yeah.
because if you close and they're still in there, and then you want to get rid of them, then it's on you.
Agreed.
So you just want to read the agreement and make sure, and you can use that actually to leverage agreements with other management companies if you want to hire someone else.
Yeah.
True.
Okay.
And those are the major brushstrokes.
That's right.
So follow that checklist. If you want the checklist of things, just send us an email, marco@marcokozlowski.com, and say, would love the commercial DD checklist, and we'd be happy to send it to you. So thanks for following along, and we'll see you in the next episode.
If you like this episode of Big Fat Real Estate Checks, then show some love by leaving a comment and a good rating. Also, as a thank you for tuning in today, we've got a special free gift. The journey to passive cash flow for a life starts by finding deals, and it's easier than you think. Simply go to getdealsbytuesday.com, enter your email address, and we'll send you a free quick start course called Deals by Tuesday. Even if it's 11 p.m. Monday night, this course will show you how to find discounted real estate deals by Tuesday. It's that fast and simple. Go to getdealsbytuesday.com and start your journey toward life-changing cash flow today. Thanks for tuning in, and we'll see you on the next episode.